Today's session is targeted or focused on tax planning strategies and or opportunities, should we say, as people, as you may have clients who have accumulated some wealth or have a successful business, and but they're not doing anything about their tax planning. This could be, for example, income tax planning, capital gains tax planning, inheritance tax planning. We'll cover quite a lot today. Right, okay, so let's get started. I'll just share my slides, if I may. Just 1 second, please. Right. There we are. Okay, hopefully everybody can see my screen. We've got quite a full-on session. There's quite a lot of things to discuss today. Anyway, just a little bit of introduction. Who we are? This is Churchill Tax Advisors. We focus mainly on the tax planning and tax strategies, tax investigations. So this is our primary focus. We're a team of chartered tax advisors, ex-HMRC tax inspectors, tax barristers, etc. And we've been there for a while. We've been in the market for a while. Tax planning, this is what we're going to cover today, hopefully. Tax planning, tax investigations, some R&D credits, a little bit of that, but more forensic accounts and investigations. So what's covered here, what we're looking at in more detail today? Capital gains tax planning, inheritance tax planning, corporate tax planning, stamp duty, refunds, protection and control of family assets, protection for minor children, income tax, wills and provisions, LLP and partnership tax planning, corporate restructuring. This is quite a common and hot topic at the moment. LLPs are quite, tax planning is quite hot. HMRC clearances and rulings, family investment companies, and last but not least, transferring properties into limited companies. Okay. People are still joining. Okay. Let's do that. Come on, next slide. So the first one that we're going to cover today is inheritance tax. As I'm receiving a lot of inquiries, maybe 3, 4, 5 inquiries every week from accountants, from solicitors, from barristers about inheritance tax planning who have wealthy clients, and they've accumulated some assets during their lifetime, and now they're more worried about the government taking 40% of everything they own. So this is a very hot topic at the moment. It has been, but it's has always been. It can have a serious impact on a family's estate. So when does inheritance tax kick in, essentially? So if you've got an estate worth over £1 million between husband and wife, so each person is entitled to £325,000 of nil rate band. Then you've got the £175,000 additional nil rate band per person for their main residence, if they're looking for the main residence, and if they plan to leave their estate to their descendants, to their direct descendants, which means their children. So if they don't have any children, then they will not be entitled to this. Or if they do not have a main residence where they live, then they will not be entitled to the additional 175,000. Okay. So if then that 325,000 plus 175,000 makes 500,000 for husband and 500,000 pounds for wife. So essentially, it makes £1 million between the two of them. And we get inquiries. I mean, today I spoke with somebody, an accountant who has got a client's worth, he's got properties worth about £8 million plus buy-to-let properties worth £8 million. His main residence is worth £3 million. He's got about £3-4 million of cash lying around. This is all subject to inheritance tax, and has to be. And the client is about 70 years old. So if we don't take any action now, the total estate was about £15 million. So the inheritance tax came to around £7 million. And in 10 years' time, that £7 million will be, because the estate will be around 30 million, the £7 million will be £14 million of inheritance tax if nothing is done. So the client is in a bit of a panic. And we need to be very, very mindful of how what's done to. Hang on, if somebody is not muted, I'm going to have to. If you're not on mute, please mute yourself politely and kindly. Okay, so I'm going to discuss all of this in a bit more detail in terms of what we can do to mitigate the tax liabilities. Just 1 second, I'm hearing some noise. I'm just going to have to mute everyone. Okay, here we go. Here we are. Okay. Next slide. We talk about trusts, and I've been asked by lots of accountants and solicitors that attend this webinar, barristers that attend this webinar, IFAs. We talk about trusts and whether it's still worthwhile doing trusts. From my perspective, from a tax planning perspective, trusts were out roughly around about 2004, 2006. Since then, it's very difficult to have trusts for tax planning. The government doesn't like it, so the rules have been designed so that the trusts are essentially prohibitive. People don't want to go near them. So if it's a larger estate, if it's a very small estate, maybe £100,000 or two, then it's fine. But if it's a larger estate, if it's anything more than £325,000, and if you settle into a trust, then you have to pay a lifetime transfer tax of 20%, and the rest. This is essentially half of your inheritance tax, which is payable whilst you're alive, and the rest is payable if you die within 7 to 10 years. And nobody, I mean, I've been in practice for a long time now, and nobody I've seen who's willing to pay this lifetime tax. There's a 6% tax, 6% up to 6% charge on trusts on every 10-year anniversary. So this could be quite a hefty bill, and there are exit charges applicable to trusts if you're closing down or taking assets out. So this can be quite costly. And last but not least, and most painful of these, is the 45% inheritance income tax charge every year, which can be very painful. And I've seen lots of people closing down trusts because of the 45% income tax charge. Although you can get credit, but it might not always work, but it still has to be paid. And it can cause serious cash flow issues. The next topic is transferring properties into limited company or incorporation. Now, I receive a lot of inquiries from people from accountants, from mortgage brokers, from solicitors, saying that, Jamal, my client wants to transfer properties into a limited company next week or in 2 weeks' time. Can you help him? And I get a lot of these inquiries. And so I thought I'd add it to this this session that we're doing so that people are aware what the main issues or what are the main items to look at, issues to look at when considering incorporation or transferring properties into a limited company. So there are two main points that you need to consider before you can transfer properties into a limited company. One is capital gains taxes payable and stamp duties payable. And there are ways to get around these. For example, for capital gains tax, is the property portfolio transfer you're transferring into a limited company, is that a business? What is a business? How does HMRC define a business? And that's something where if HMRC can, if we can prove to HMRC or prove to HMRC that we're spending 20 hours a week, if somebody's spending 20 hours a week on looking after their property portfolio, and that 20 hours a week must be verifiable, then we can then you get an exemption, okay, because it's essentially is treated as a trade. There are people who would immediately say, yes, I do 20 hours a week when I ask them the question, but when you dig in deeper, they don't qualify. So this is something that you need to be very mindful of. If somebody doesn't qualify, and you've gone ahead with a transfer into a limited company, then an HMRC investigate this and they're successful in proving that you don't qualify, then you could potentially, it could cost you a lot of money. It could cost you, I mean, we've got one client at the moment who did wrong incorporation without taking any advice. He came to me now, he's come to me now that he's being investigated by HMRC. He did incorporation through somebody else, but he's having to pay £600,000 with penalties, with interest. Okay, so you need to be very, very careful before you decide on incorporation. Stamp duty is another hurdle that you need to be aware of. And the way to get around stamp duty is to set up a partnership and to run the partnership as a business for a couple of years and then incorporate, because when you incorporate from a partnership, there's no stamp duty payable. Okay. Benefits of incorporation. So once you transfer properties into a limited company, you don't have to worry about Section 24 restriction on the mortgage interest. But it hasn't been applied yet, but you never know. The government might introduce something for limited companies as well, just to make it a kind of a playing field. And also, there's no capital gains tax on transfer of properties. There's stamp duty savings, but what's not mentioned on these slides is a saving where the capital gain on the properties essentially vanishes. So let me give you an example. If you've got if I bought a property for 100,000, say 20 years ago, and now it's worth £1 million. Okay. If I sell the property now in open market, I'll make a capital gain of £900,000. And I'll have to pay capital gains tax at 28%. But if I incorporate today and transfer into a limited company and then sell the property through the limited company tomorrow, there will be no capital gains tax to pay at all, because the company will buy it from me at the market value at the date of death, in the market value at the date of transfer. And when the company sells it, its base cost will be £1 million and it will sell it for £1 million. So the capital gain essentially vanishes completely. And if you do it properly, and we do this for quite a lot of our clients, if you structure it correctly, and this can be a lot of savings. Drawbacks of incorporation. So you need to be aware of, don't always think about the negative positives, always give more time to the negatives. of incorporation, because that's where people make mistakes, and that's where these mistakes are irreversible. So the government can change the rules for Section 24. There's a stamp duty risk because HMRC can apply anti-avoidance provisions under Section 75A to say that you set up the partnership and everything just to avoid tax, and because you had a tax avoidance motive, you cannot qualify. There's also mortgage transfer costs. A lot of people don't consider the mortgage transfer costs. Hang on. Right. So mortgage transfer costs, I have one client who's just done an incorporation, completed an incorporation. We did that about 2 weeks ago. And the mortgage transfer costs were just over £100,000. And lastly, inheritance tax is a very painful reality of it, transferring properties into limited companies, because inheritance tax gets worse. It really gets worse, the inheritance tax situation. So you need to be very mindful of what you're doing and what the short and long-term benefits are, because once the properties go into a limited company, they're stuck forever. They cannot come out. So if somebody dies and inheritance tax needs to be paid, and this is the real life scenario that we dealt with, or we are still dealing with, is the client is having to pay £4 million of inheritance tax. The client passed away, and his relatives need to pay £4 million of inheritance tax, but all the assets are within the limited company. The company will need to make a sale and pay capital gains tax, and then pay out dividends on which the beneficiaries will need to pay income tax before they pay the £44 million inheritance tax. So you need to be very careful here. Most of the people that I speak to have no idea about this, absolutely no idea. And they are willy-nilly advising clients to transfer properties into a limited company. Okay, so you need to be mindful of this. Growth shares are a wonderful instrument. I am, in fact, before this session, I was writing up some documentation for growth shares for a client. And this can be used very effectively to mitigate inheritance tax or other taxes. So if you have, for example, a property company, and you have lots of property sitting in that company, you can freeze the value of existing shares and give growth shares to the children. So parents don't get any further increase in value, and everything belongs to the children from this point onwards. There's no capital gains tax, there's no stamp duty, there's no clearance required from HMRC. Okay. And you can protect the parents from future rise in value for the properties. The process is complex, but it has many benefits. And you can also issue growth shares in limited companies, in trading companies. Okay. We're doing something. We've just done growth shares for a pharmaceutical business, and they've got new management coming in. The management have more to motivate the management to say, okay, current value of the business is 10 million. If you take the business to 15 million, you can have 20% of the share, and that's how we operate growth shares. Some people offer, for example, EMI shares, and but they're absolute nightmare. You have to get a clearance from HMRC. You have to comply with the rules, and if something goes bad, then the whole scheme collapses, and you've still got to pay tax. So EMI shares are not very attractive in my view, because I've been doing this for a very long time, and I find growth shares to be much more superior than EMI shares. Next topic is LLP, or partnership structuring and planning. So this could be very useful for inheritance tax planning or asset protection or income tax planning. So there's quite a lot of benefits in this. Essentially, if I give you an example of how this works, say husband has assets worth £10 million. They have 3 children. So him and his wife and children create a partnership or LLP. We transfer the properties into the LLP, which creates essentially a capital account for the husband or for the dad. He then gifts the equity in the properties through the partnership capital account to the children. There's no capital gains tax on that. So there's no capital gains tax is not triggered. But what's triggered is a 7-year clock, because this is a potentially exempt transfer or a pet. It triggers a 7-year clock. So if the father then passes away within the 7 years of making this gift, then there's inheritance tax to pay. So the way this works is this sort of tapering basis. The first 3 years, if the father passes away, there's inheritance tax payable at 40%. Okay. And year 4 is 30%, year 5 is 20%, and then it goes to 7. And after 7 years, it becomes 0. Very effective tax planning. It's not overnight. It's not overnight, so that's why HMRC like this a lot. There's no capital gains tax being avoided, but it does help. You can divide the income in the partnership between the husband and the wife and the children as well. Assets are ring-fenced. You can use a management company as well if need be to take some profits out of the LLP, put it into a management company to be taxed at a lower corporation tax rate. Okay. Restructuring. So this is another quite a popular, and I'm speaking to a number of accountants and solicitors at the moment on different types of restructurings and how this could benefit their clients. I'm working on quite a few. In fact, I'm doing quite a major restructure at the moment, and I've got an example of that. I've got some slides of that in the coming slides. So this is one example where we have UK shareholders which own an offshore BVI entity. Okay. Offshore BVI entity owns a BVI property company. So this is a holding company, it's a property company. Then we have properties in the UK. The portfolio is worth, say, £30 million, just as an example. They cannot get mortgage on these properties because of the BVI connection. It's very difficult to get a mortgage. There are UK plus the offshore nominees, the trustees, they write themselves a blank check essentially every year. They charge a lot of money. So the shareholders, the clients came to me and said, Jamal, we need to get rid of everything that's onshore. Just bring everything onshore for us, please. So this is what we did. This is part of the restructure. So we set up inserted a new UK company between offshore holding and offshore BVI co. We created a group. So we transferred the properties into a UK subsidiary. Okay. And ultimately we ended up in this with this structure. So we had the UK owners, new UK company, limited company, which owns properties. So from here to here, essentially. Now you've got all your offshore charges are gone, your bank restrictions are gone. You can get really decent mortgages, loans, and you can do anything with these properties. Before, it was absolute nightmare. Here's another restructure, which is essentially a demerger that I did for a client. I'll kind of explain the scenario. So this AB Limited started as a trade from a warehouse, and the trade grew, and this has been going on for many, over 30 years. So there was essentially it was a trade and a warehouse, but as they became cash rich, they started going into properties or investment properties. So they started buying investment properties year after year. Now they've got a sizable property portfolio sitting in this limited company. And now the bank is telling them there is too much risk. The auditors are telling them there's too much risk. There's too much happening. Accountants aren't telling them there's too much risk because you can't have such a large portfolio of properties and a trade running in the same company. You've got to demerge them. So they've kind of finally understood. So the objective was to do a demerger. So we separate the property business from the trade and the warehouse. So this was step one of the demerger, to set up a new Co 1 and new Co 2. Okay. And underneath the main AB Limited, step 2 was to transfer the trade and the warehouse into new Co 1 and the property portfolio into new Co 2. Okay. Step 3, or slide 4, step 3 was that there's nothing owned by AB Limited which becomes dormant. New Co 1 is now active with the trade and the warehouse. New Co 2 is active with the property portfolio, and shareholder 1 and 2 own shares in both. So the final end piece was that the old company is gone, and these two companies are now independent, but shareholder 1 and shareholder 2 own them. There's no risk from one to the other now, essentially. The restructuring process, you have to get a clearance from HMRC. You can't do it without a clearance. You can do it, but it's better to get a stamp of a seal of approval from HMRC so you don't have a problem later on. And HMRC can reject your application, various factors they look at. They have 30 days to respond to your application, and or they can say yes or no. And if sometimes what they would do on day 29 or day 30, they would send you an email to say, we need more information. So you have to provide it to them. And as soon as you provide it to them, then they have 30 days. So they can continue buying time. But anyway, once you know the process, then it's much easier. And once you've had the acceptance or clearance, then you start the real restructure. That's when the real work starts. A lot of people think it's impossible to get a clearance. And once you start the restructure, then yeah, that takes a while, but you've got to do it properly. And we've done kind of tons and tons of hundreds of these. Once that's completed, yeah, then you may need to get adjudication from HMRC. The total time frame for a restructure is approximately 6 to 8 months. But it's very much worth it. Once it's done, the benefits are far more than the waiting time. Why do tax planning? Yeah, I rest my case on why do tax planning, because you can pay less tax and it's to your right, or do nothing about it. Tax savings for you and tax savings for your family. Tax investigation. So this is another kind of branch within Churchill Tax, where we have ex-HMRC inspectors as our colleagues who help on this side, and I get involved, and we've got some specialists who've dealt with this type of litigation. I get involved in tribunal and alternate dispute resolution matters. But anyway, I'm going to take you through what we deal with. So we deal with Code of Practice 8, Code of Practice 9, on fraud investigations, VAT investigations, compliance checks, customs investigations, POCA, first-tier tribunal, upper-tier tribunal, worldwide disclosure facilities, let property campaigns, and alternate dispute resolution. I will look into Code of Practice 9 in a bit more detail, as this is the most severe or the most kind of serious of all investigations, civil investigations, which turns into a criminal if not dealt with properly. So it's also known as Contractual Disclosure Facility. It's issued by HMRC when they suspect serious tax fraud and they have intelligence. that somebody's involved, and they do their research, and they find out, yes, this person's tax affairs do not make sense. So they send that person an opening letter, which is under Code of Practice 9 or Contractual Disclosure Facility. The opening letter gives them the taxpayer a choice, which it says essentially that we know that you're involved in tax fraud. You have a choice. You either come clean, tell us what you've done wrong and how much tax you need to pay, or if you don't, we will investigate you, and if we can prove that you have been committing tax fraud, then we will prosecute you and we will put you in prison, essentially. But if you say, yes, I will come clean, then you get immunity from prosecution. So that's why it's called Contractual Disclosure Facility. If you disclose, then yeah, contractually you get immunity. So the first step is to prepare an outline disclosure, which goes over 2 to 3 pages. We send it to HMRC. It says that, yes, I've been committing tax fraud. I have for the last 20 years, but I'll be working with my accountants, my advisors, to quantify the amount, and and we send that to HMRC. We tell HMRC then compare that with their notes to see if he's missed anything. But there's no tax involved at this stage. No, we don't mention any tax liabilities by HMRC. Then we have a meeting called a scoping meeting with HMRC. It goes on for about 3-4 hours, in which we discuss what needs to be done. We've discussed the outline disclosure report that has been submitted, and what needs to be done, and how long before we submit the final Code of Practice 9 report, which goes over about 40, 50, maybe 80 pages, up to 100 pages long. In that report, we cover the last 20 years of the person's tax affairs and what they've been involved in, and how much money they've made, and how much tax is underpaid. We prepare that, we calculate the penalties and the interest and everything, and then we submit that to HMRC. HMRC then raise questions. There's a couple of disputes to and fro, and finally we reach a settlement. This is a very, very long process. It can take up to about between 2 and 7 years. Some can go up to 10 years. I've seen a few cases that have gone up as long as 10 years. But it is a very long process, and it's very scary, because I've seen lots of people go to prison following a Code of Practice 9 investigation. So something we've currently at the moment, we've got about 25 of these ongoing, and we deal with it. We know the process. But if you've got anything, just give me a call and I can walk you through. We also do forensic accounts, and this is for company and partnership fraud investigations, or commercial dispute, divorce settlements. But we work with we do business valuations, mostly working for solicitors on this one. Okay, stamp duty refunds. Yes, we can do some. If you've bought a property which is derelict, and you've paid the additional 3% stamp duty on it, there is case law which allows you to reclaim some refund if the property was derelict and uninhabitable. Okay, well, that's it. That's me. And you've got my email address here and my telephone number here. If you've got any questions, I'm more than happy to help. Usually people contact me by email after the session. Some people contact me by phone, but most of them contact me by email. My secretary will send you these slides hopefully tomorrow. But if you've got any questions, I'd be more than happy to help. Let me see if you've got somebody sent any questions. How long do you expect the session to last? Well, it's coming to the end now. Would you pay? So I've got a question from Andy. Would pay CGT, not CG, corporation tax, not CGT? Correction. Yeah, fine. I'm guessing you're talking about in-corp when you're transferring, when you're selling properties in limited company. Can we get a recording? Yeah, well, I can try and get the recording for you. That's not a problem. I'm recording the session anyway. Excellent. There's no more questions. Okay, I guess people are saving the questions for
Hi.
Until after the session. Hi.
One question. Incorporating, going into a partnership and then incorporating property business, the 20-hour working for partners. Do all partners have to put 20 hours each, or one will suffice?
I think as long as we can show that it's ideally it's each. But I've seen cases where HMRC have said, I mean, how many? First of all, how many partners are there? Two partners. So I think between the two of them, as long as they're spending 20 hours a week between the two of them, it's fine. There's no issue. I'm assuming there's husband and wife, right?
And I think there is a minimum of 4 properties for the partnership. Is that right?
No, there's no minimum. There's no minimum at all.
Okay.
But I think you can't justify 4 properties and which are on AST and you're spending 20 hours a week. I've been through so many difficult cases on this one and negotiated deals with HMRC, settlements with HMRC, because you can't say with 4 or 5 properties you've got a partnership and then you're spending 20 hours a week. It has to be at least 8, 9, I would say, or more, in my view. But you could have, for example, 2 HMOs, right? You could have 2 HMOs and you could be spending 20 hours a week easily in 2 HMOs.
If you're providing services like cleaning and gardening, whatever you need, 20 hours for property.
If you are providing, if it's an AST, and if you are providing cleaning and gardening and those services, and if you can show that you're actually doing that, if you can demonstrate 20 hours a week, that's absolutely fine. There's no harm with that. But for example, for a typical landlord who doesn't, it's an AST, then that becomes very difficult, because I've got live investigation cases at the moment where HMRC are not accepting anything.
Yeah.
They're saying, no, you're not telling the truth. There's no record. They will go to the tenants and they will ask the tenants, does this guy come to the house to clean it every week? Does this guy come to the house and do the garden every week? They will take written statements. So it can get, if you get it wrong, especially they will question incorporation if there's very few properties involved. If there's, I mean, I've got one client at the moment, we're doing 16 properties for them. And it's very straightforward. I don't think there's any issues involved. But this guy's life is about these properties. And somebody who came to me and said, I've got 5 properties or 6 properties. They're all managed by estate agents. I do nothing, but I want to incorporate because I can get tax relief for the mortgage interest. I said, no, we're not going to let you. And that guy was like, I want to do it. I said, well, no, you're not going to do it because you're going to have a problem. I gave him an indication of the tax that you will end up paying if HMRC investigated. And you've got no chance of success. And then ultimately he listened.
Okay, thanks.
Any other questions? Oh, someone got some cost indication. Cost from Nick. Okay, cost indications for what? Can we assign income from the trust to someone else to avoid 45%? No, you can't. It's the trust pays tax. Okay. Yes, Andy.
Circling back to the structure of the LLP and the equity, could you just run that by one more time?
Sorry, I it would be a difficult one because I have to know. But Andy, why don't you just send me an email?
Okay, I'll send you an email.
I have
That's fine.
Pick up my son. But if you send me an email,
no problem.
I'd be more than happy to have a kind of a private chat with you.
Thank you. And one last question regarding the code 9. Sorry, we just received one today in the post.
Goodness.
So I might need to run that by you as well, and maybe even get a cost from yourselves on how to handle that case. Yeah, literally the letter came today.
Did you get my email there?
I've got your email, yes.
Just send me an email and we'll catch up.
Okay, thank you, Jamal.
Excellent. Well, anything else for anyone? Any other questions? No. Nick Dunn is asking your fee for buy-to-let incorporation for all stages. Nick, it depends on the circumstances. So if you send me an email, Nick, I'll definitely have a chat with you and kind of give you walk you through the process and what it involves. But thanks a lot, guys. Take care. Bye.